Hey guys, welcome back to my channel. Let's talk about mortgage. Are you financially ready to buy a house? Ever thought about your affordability? Now, if you feel like you are ready to buy a house, the first question you are likely to ask yourself is this: how much can I afford? Answering that question means taking a look at a number of factors. You will need to consider more than just finances. Before you snap up that seemingly great buy on house, learn how to analyze what affordability means. Now, the first point, understand your affordability. There's no point in diving into a home search without first knowing what you are looking for. And when it comes down to it, that begins with your budget. You will need to consider various factors ranging from the debt to income, or we call it a DTI ratio, to mortgage rates. The first and most obvious decision point involves money. If you have sufficient means to purchase a house for cash, then you certainly can afford to buy one now. Even if you can't pay in cash, most experts would agree that you can afford the purchase if you can qualify for a mortgage on a new home. Now, but how much mortgage can you afford? If you are staying in Malaysia, experts will advise that your monthly installments shouldn't exceed 1/3 of your household income. Let's say you have a total combined income of 9,000. The monthly installment of your house must not be more than 3,000. In our countries, lenders will generally be looking at your DTI ratio. This ratio is used to determine if the borrower can make their payments each month. Some lenders may be more lenient or more rigid, depending on the real estate market and general economic conditions. Bottom line is, less debt is always better, and you are likely to secure a mortgage. The second point, what mortgage lenders want? Now, you need to consider the front-end debt-to-income ratio, which calculates your income versus the monthly debt you will incur from housing expenses alone. Now, why wouldn't you be able to use your full debt-to-income ratio if you don't have other debt? Basically, it's because lenders do not like you to be living on the edge. Financial misfortunes may happen to everyone. You may lose your job, or a medical disability may prevent you from working for a while. If your mortgage takes up majority of your total expenses, you will have no wiggle room for when you want to or have to incur additional expenses. Most mortgages are long-term commitments. Keep in mind that you may be making those payments every month for the next 30 over years. Accordingly, you should evaluate the reliability of your primary source of income. You should also consider your prospect for the future and the likelihood that your expenses will rise over time. Getting approved for a mortgage up to a certain amount doesn't mean you can actually afford the payments. So, be honest about the level of financial risk that you are comfortable living with. Now, the third point, can you afford the down payment? In general, the down payment may be somewhere between 10% to 20% of the total cost of the property that you will need to pay upfront. There may be some reasons that you might just want to put down 10% towards your purchase. Perhaps you are not planning on living in the house very long, or you have long-term plans to convert the house into an investment property. Similarly, you might not want to put that much cash down. If that's the case, buying a house is possible without 10% down. Being able to afford a new house today isn't nearly as important as your ability to afford it over the long haul. Needless to say, being able to afford a house and having a down payment doesn't answer the question of whether now is a good time for you to act on that option. Now, the next point will be the housing market. Assuming you have your personal money situation under control, your next consideration is housing market economics. either in your current local or the one where you plan to move. A house is an expensive investment. Having the money to make the purchase is great, but it doesn't answer the question of whether or not the purchase makes sense from a financial perspective. One way to do this is to answer the question, is it cheaper to rent than to buy? If buying works out to be less expensive than renting, there's a strong argument in favor of purchasing. Similarly, it is worth thinking about the longer term implication of a house purchase. For generations, buying a house was almost a guaranteed way to make money. Your grandparents could have bought a home 50 years ago for $20,000 and sold it for 4 or 10 times that amount 30 years later. Now, while real estate has traditionally been considered a safe long-term investment, recession and other disasters can test that theory and make potential homeowners think twice. During the Great Recession, many homeowners lost money when the real estate market crashed back in 2007 and ended up owning homes that were worth far less than the price at which they were purchased for many years after. If you are buying the property on the belief that it will rise in value over time, be sure to factor the cost of interest payments on your mortgage, as well as the upgrades to the property and ongoing or routine maintenance into your calculation. Let me know your thoughts on this in the comment section below. Don't forget to subscribe, hit that notification bell, give the video a like and share it with your friends and family. Thank you very much for tuning in, and I'll see you in the next one.